Today, December 26th, we started to take profits on our Chewy trade, which is at 113% gain because of the unusual options we detected today. And so in this video, we will review our current trade in Chewy and why we are trimming our position based on the data from today. So if you've been following this channel, you know that on this red down day on Chewy, December 14, when everyone was selling, we were buying, and we published this December 14 video on this day. This is the title of the video: Chewy stock, why bet $400,000 of options. We'll put a link at the top here, so if you missed out on this video, you can follow along and see that these call options that were worth $69 each are now worth $145 each. Okay, so that is why this trade is now 113%, because we can sell it back for 145. And so when we take a look at the profit loss diagram, you can see here the profit on these call options, $78 each. And as mentioned, they were going for $69 each, these 30 strike calls that we discussed on December 14. Okay, so $78 profit divided by the cost of 69 times 100 is 113% gain. Okay, so we made over 100% on this, essentially in 7 trading days, because you can see here this was December 14. What's 1 day, 2 day, 3 day, 4 day, 5, 6, 7, right? So today we can see here that the price now at $23.76. So in 7 trading days, the stock was up 17.72%, but our options trade 113% gain. Okay, so quite a big difference, and that is why we like to use options to optimize our profits while reducing our risk. And for today's unusual options that we detected, we are doing just that again. You can see here that these unusual options are actually at a ratio of 1 to 2. Because you can see that if you take 3,999 and multiply by 2, this is this 7,998. So what are they doing? This is a ratio option strategy here. Okay, you can see that this is for the January 5th 23.5 strike puts and the 20.5 strike puts. So when we take a look at January 5th, this is 10 days away. We can see here the 23.5 strike puts and the 20.5 strike puts. We know these are opening trades because the open interest is much less. So we believe this trader, who is very wealthy, because the cost of this trade is quite a lot. Okay, they are buying the 23.5 strike puts and then selling 2 of the 20.5 strike puts. And when you analyze this trade, okay, this is what this wealthy trader is doing, a back ratio strategy here. Okay, and because one of these puts here is a -1, that means one of these puts is a naked put. okay, which is essentially a cash secure put, right? They're essentially saying they're willing to own Chewy at $20.50 a share. So that's 100 shares, right? By selling that put naked, okay? And we know they did about 4,000 contracts. So we multiply by 4,000, and so this trade required $8.2 million. That's why we know that this is a wealthy investor who is trading, right? And that's how we determine whether or not this trader or this data is significant. Is it meaningful or not? One of the variables that we take a look at is the overall trade cost, okay? And it's relative to the market cap of the company. That matters, okay? So this investor now thinks Chewy could potentially go down, and that's why they're shorting Chewy now. You can see here a negative 28 delta on the Greeks, okay? And that is why we wanted to start trimming our position, okay? We didn't take all of our contracts off yet, right? We are still in this position with some of our contracts. We trimmed to reduce our risk. That is what we do for our strategies. We did add, you can see here, a put spread here, right here. Our position here where we bought the 22 strike puts and sold the 20.5 strike puts. So what we did was we added some of these puts, adding this put vertical spread. You can see that it costs about just $19 each. Okay, very cheap hedges essentially. Okay, that is also a short position, and you can see that by adding this into our trade now, if Chewy were to go down, okay, you'll see the price of the share on the x-axis, we would not be much at a loss, right? In fact, we would be a gain right around this price, a max gain here at around $20 here. You can see that it could potentially make $114 per trade here, right? If it expires around $20.37. Okay, so this is how we can reduce our risk while optimizing our profits, because if Chewy continues to go up, we could continue to also make money here, right? Essentially this trade, notice that wherever we go, the only place that it actually dips to the negative below this zero, where this trade could be potentially a loss, because anything below this, if the line is below it, that's a loss. If it's above it, that's a gain. So notice the blue line at expiration, the only place that it is below this zero line is right here, right around here, right? This is our break-even points, around $22, right? And it's only about $22 and $22.09. So there's only such a narrow window that we could potentially lose on this trade, which is why this trade has very low risk. And this is how we trade, why we use strategies that are based on the data of the wealthy investors. And we can maximize our profits as we've done. If you've been following this channel, you can see a lot of our strategies, and especially if you are one of our members, you get access to our strategies. If you are interested in our stock picks and our strategies, make sure to go to our website where we share this type of data with our members only. Put a link here. And also make sure to watch this video. We'll put a link here as well so you can learn how we were able to predict this and make 113% in 7 trading days. As usual, please smash the like button, comment below if you were also in this Chewy trade when we publish this video on December 14. Take care and have a great day.